Hi everybody, welcome along to the third part of our property investment webinar called The Best of Both Worlds. You're listening to Lucas Rogers. I'm the CEO of the Rogers Property Group, and the best of both worlds is referring to getting not only cash flow positive property, but also capital growth out of that property as well. Now, a lot of people believe that you can't have both positive cash flow and capital growth, but I'm here to tell you today that that is not true. You can get both. I'm currently getting it on my property portfolio at the moment, and my clients are as well. And there's no reason why you can't. You just have to structure things correctly and know exactly what you're doing. It's like putting all the parts of the jigsaw puzzle together. If you want to contact me, send me any emails, any questions, please do at info@rogerspropertygroup.com.au or our 1300 number, which is 1300 148 178. I'm also putting out content regularly on Facebook and Instagram, so if you want to subscribe to those channels and give us a thumbs up, that'd be great, and I'll keep you up to date on what's happening in the property market. Little bit of background on me for those of you who've listened to part 1 and part 2. So you're going to know this. I'll quickly run over it anyway for people who are just joining us for the property section of part 3. My background is I'm a chartered accountant. I used to work for one of the big 4 accounting firms before I moved to London. I worked in London in investment banks over there for bit over 7 years. I returned to Australia. I started working in property finance and property development and in property investment. And I worked in there I got qualified as a chartered accountant. I was already qualified as a chartered accountant, got qualified as a financial planner and also a mortgage broker as well. And, look, I've been in the industry now for well over 13 years, and I've built with hundreds of millions of dollars worth of property investing, capital raisings and so forth. So I've had plenty of experience in the market. I speak on behalf of the Australian federal government, so I do all their keynote speaking in regards to property investing. So I've spoken from all over Australia, from Perth all the way to Brisbane, teaching the general public on how to make money out of property investing. And the reason why they do that is because they want to try and keep people off the pension. If you'd listened to part 1 of this webinar series, then you'd realise that, or you'd know that, I should say, that there are less taxpayers now to every pensioner, and so the government wants people to get off the pension, so they want them to become self-funded retirees. So therefore they asked me to teach people how to make money out of property. I've also written a book on property investing. It's called The Complete Guide to Property Investing in Australia. It's a great read. It's 180 pages. It generally retails for around $29.95 in the shops. But if you would like a free copy, I'd be more than happy to send you one out. Just send me an email at info@rogerspropertygroup.com.au or give us a call on the 1300 number, and I'll make sure one gets out to you for free. So guys, we've done 2 parts to this 3-part webinar series. We've talked about you getting your mindset right to be successful in property investing. Pardon me. Secondly, we've spoken about finance, different financial structures that you can buy property in, things to look for, things to avoid. We've done those 2, guys. Well done. So we're moving right along now to part 3. But can I say, though, that remember that the 3 different parts of property investing, you, finance and property, they are all just as important as one another. You can have the best property in the world, but if it's financed incorrectly, it's going to go bad. Likewise, you can have the greatest financing in the world, and if you don't have the right property, then things aren't going to work out in the long run anyway. So guys, let's now have a look at property. This is going to be the juiciest part of the 3-part series. You're going to really enjoy it. There's lots of tips and tricks in here, how to turbocharge the cash flow from your property and how to also predict property hotspots and find great growth areas. Some key things to know if you're looking to get started in property investing, and it's Rule 101 when it comes to property. And I'll throw a little question at you. What do we look for? Do we invest for rent, or do we invest for capital growth if we want to build wealth? What do we do? Guys, have a think about it, but the answer to the question is we want to go for capital growth, not rent. Okay, we want to aim for capital growth because at the end of the day, that is what's going to make us wealthy. Rent doesn't make us wealthy. So aim for capital growth. Now, if we're aiming for capital growth, there is two parts to any property. One part is the land, and then the second part of that property is the apartment, the structure, the house that sits on that land. Now, what part of that do you think is going to grow the fastest in value? House or land, or structure or land? Guys, it's going to be the land. Land appreciates, buildings depreciate in value, okay? So the growth, the capital growth comes from the land. Okay? Two rules when it comes to property investing. Focus on capital growth, that's the first thing. And secondly, where does the growth come from? It comes from the land, so focus on the land. Okay? So, but it's not, I wouldn't be suggesting everybody race out there and buy land, and we'll get into this in a bit more detail in a moment. And we don't necessarily need to focus on the size of the land, because people get caught up with all sorts of silly talk. Oh, I need 1,000 square metre block or whatever, or, you know, that's irrelevant. Okay? 1,000 square metres in the western suburbs would generally not perform as well as, say, 400 square metres in the eastern suburbs, whether it's Brisbane, Sydney, whatever it may be. And that's because the land value is so much higher in the eastern suburbs, okay? So, you know, you need to be looking for property that, has a good, what we call land content. We don't necessarily need to worry about the size of the land. We need to worry about the land content. And the land content is actually an equation. Land content equals the value of the land divided by the total value of the house and land, or the total value of the property, okay? And it's expressed as a percentage. So value of land divided by the total value. So to give you a quick example, let's say that we have a $200,000 block of land, and on that is sitting a $200,000 house. What's our land content? Well, it means the land, $200,000 divided by the total, which is 400, means that we've got a land content of 50%. Now, land content of 50% is a good ratio for us to be looking at. It means that we're going to be getting the best mix of capital growth and, of course, cash flow as well. But what we want to be looking for with our land content is to go between 30 and 70%. We don't want to go below 30%, because if we go below 30%, it means that I'm getting a poor capital growth because I've got too much money made up in the house or the structure. And I don't want to go above 70%, because if I go above 70%, what does that tell me? It tells me that the house that sits on my land is a real disaster, and it's going to cost me too much in cash flow to keep the thing afloat. It's not going to give me enough rent, tax deductions, and so on. So that's not particularly where we want to be at the higher end. We want to be midway there between 30 and 70%, and that's going to be a good asset for us. Okay, so let's break down the types of residential assets that we can buy and see if they fit within that 30 to 70% category. So starting from the bottom upwards, an apartment. Does an apartment fit within 30 to 70? No, it doesn't. It doesn't, because apartments are generally 95% of their value is made up in their structure, and only about 5, maybe 10% is located in the land portion. So that means that we've got 95% of the value of our asset is actually going backwards in value. Okay, so apartments, not an asset that I invest in personally, and certainly not an asset that I advise my clients to get into either. Moving up the scale from there, we've got our apartments. As I said, we've got apartments, townhouses, houses, and then we've got our dual occupancies, etc. on top of that. Okay, most residential property fits within those 4 categories, although there is variations and so on. Okay, so we've discounted apartments. We don't want to be buying those. Moving upwards from there, a townhouse. Yes, a townhouse can fit within our 30 to 70% land content, depending on where it's located. Because it has a smaller piece of land, we need to go somewhere where it's very well located and we're paying a little bit more money for the land, because it costs the same to build a townhouse out in Ipswich as it does to build one, say, close to the centre of the Brisbane CBD. It's just the land value is going to be different. Okay, so you need to be well located, but a townhouse does fit. A house, moving upwards again, Yes, a house will fit within our 30 to 70%, and that's generally our ideal asset to buy because it fits. It's generally around 50% land content. Okay, houses are generally fairly easy to rent out, and people know what they're in for. So they're a very good, strong, safe investment. And then moving upwards from there, dual occupancies and duplexes, which we'll get into at a later stage. Okay, so we've decided we want to have a well-located townhouse, or we need a house, or potentially dual occupancy, but no apartments. So where are we going to put that? Where are we going to build that asset, or where are we going to buy that asset? Now, with the likes of realestate.com and investment companies out there, guys, you can be investing anywhere from Cape York right down to the southwestern part of WA, Margaret River, or wherever that may be. So where are you going to do it? Well, what I do with any asset that I'm looking to invest in, I apply a very simple economic equation. And in property, we call these the property macros. Okay? Now, property macros, it's economics 101. And it is an increase in the demand of a product plus the decrease in the supply of that product is going to give us an increase in price. Increase in demand, decrease in supply means an increase in price. So let's look at that equation for a moment now. Can anybody remember back in, I think it was 2010, when Cyclone Yasi knocked out the banana plantations of North Queensland? Anybody remember back that far? Yeah. What happened to the price of bananas? They went through the roof. They went from like $2 a kilo to like $15 a kilo. And that was just because supply was disrupted so much. Imagine if there was an increase in demand on top of that, they would have gone to $30 a kilo. So now what we've got to do is we've got to apply that same equation to property and say, okay, well, what creates demand in property? And demand in property is created by our population growth. If you're a serious property investor, like we are here at the Rogers Property Group, you need to track your population growth rates across Australia. And you can see here from this graph that our three big states are giving us our major portion of our population growth. WA to a lesser extent, you look at a place like Northern Territory, they went through a population boom a few years ago, and they got 5,000 people. I mean, compare that to Melbourne. I mean, there's no question asked as to where you would buy. So go for where the population is growing. Moving out to 2050, where's our population growing? Well, you can see that your three big states are going to double in size over the next sort of 30 odd years. So they're the places where you want to be investing. Getting back to our property macros, an increase in demand plus a decrease in supply is going to give us an increase in price. So we've looked at our demand side, our population growth, okay? Now what we've got to do is we've got to find out where supply is not keeping up with demand. And where supply is not keeping up with demand, it means we're going to have what we call a supply deficit gap. And the bigger this supply deficit gap, the more price increase we can anticipate. So where is property undersupplied around Australia at the moment? You can see here that if you have a look there, it's a confusing looking graph, but New South Wales undersupplied, Victoria undersupplied, Queensland is very undersupplied at the moment as well. South Australia is oversupplied, and WA is grossly oversupplied at the moment. Okay, and that's why their property conditions are so poor for investors at the moment, because things are actually gone a little bit backwards there. So they've just oversupplied that market. But in New South Wales, Victoria and Queensland, they're our best markets to be in because they have that big supply deficit gap. Probably all the markets considered at the moment, Queensland, Southeast Queensland, your Brisbane, sort of from that triangle of Brisbane down to the Gold Coast, and a little bit west, not too far west, is probably your best place to be investing in property anywhere in Australia at the moment. Sydney and Melbourne, or New South Wales and Victoria, I should say, those markets are fairly overheated at the moment. New South Wales has come off the boil, and so has Victoria as well. So all the investors have pulled out of there and are starting to push their money into Queensland. So that will start to dry up stock even further. It'll make further housing shortages, and it will push prices up even further. So Queensland is definitely the market that I'd be looking at the moment. Okay, but where within that market? Okay, we say, okay, well, look, Southeast Queensland, great. That's a good market to be in. Where within that market are we going to be looking at? What's going to give us the good price increase? Well, I've got a location criteria here that I look at and I apply to the properties that I'm buying. I want to be close to schools, okay, because we're building houses. They want to be, houses have kids, or they have families have kids and they need to go to school, so we need to be near some schools. We need to be in an area where there's a high percentage of owner occupiers, okay? If we go out to an area like, what's a good area to look at? Gladstone, that's a classic. It's full of investors. And that's why when the market gets hammered, everybody starts to pull their money out, okay? And then what happens when they pull their money out and they want to sell their properties? Of course, more stock comes onto the market, there's less buyers, and then things spiral downwards from there, okay? So that's what happens. Places like Chinchilla, Moranbah and so on, not places you want to be in because they don't have a high percentage of owner occupiers. We need to be close to transport, not necessarily walking distance to a train or anything like that, as a lot of people think. You just need to be close to transport, and that can include major roadways. From, say, Brisbane to the Gold Coast, you want to be somewhere near the Pacific Motorway because that is the artery that keeps Southeast Queensland going. Okay, shops. We need to be close to shops. If you like, everybody needs to go shopping, buy groceries and things like that. We need to be in an area where there's multiple employment streams. Very, very important from a growth perspective, but not only that, is from a safety perspective as well. As I said before, I referred to Gladstone and Moranbah. Now, those areas are based really totally on mining. And when mining comes off the boil and the jobs, the jobs contract a little bit, everybody's going to move out of town. And if everybody moves out of town, your population growth is reduced, more supply, it comes onto the market there, and it's a catch-22 and things downward from there. So my advice to you is always buy within a reasonable distance to a capital city CBD. And I don't mean 5 kilometres, depending on your budget, it might be 10, might be 30 kilometres, even 40 kilometres. But 30 is about my limit at the moment of where you want to be close to a CBD. If you can do that, you know that there's always going to be a steady supply of jobs, and therefore your property's always going to grow in value over the longer term. We also need to be near recreational facilities as well, parks, kids need to kick a footy, things like coffee shops and stuff like that as well. Capital benchmark, so we need to be able to go through our suburb and see houses where people have spent twice what we've spent on our house. That brings our house upwards in value because the same common denominator between the two houses is the land, the same cost per square metre. It's just if they spent more money on their build, they're going to bring ours upwards in value. So that's a very strong location criteria there. People always ask me, Lucas, do you think property is going to continue to grow in value? Well, I don't have a crystal ball, but I would say that judging on previous figures, the last 50 years history, plus from what we're seeing at the moment in regards to undersupply and our Australia's overall population growth, it's highly likely that property is going to continue to grow. I'm sure that say you look at Brisbane or even look at Sydney, I'm sure that people in Sydney back in 1970, when they're buying houses for under $20,000, they wouldn't have thought that, oh, hang on, back in the year 2016, I would be paying $1.2 million for your average Sydney home. People just wouldn't thought that would be possible. I mean, in the next 10, 15 years, we'll be paying $2-3 million for your average place. It's just going to happen. It's just, it doubles around about every 10 years. Let's have a look at here. So to look at the Sydney market, that's a nice easy one to look at. That went up in the last calendar year by $150,000. When we divide that per week, that's close to $3,000 per week that the market is growing at. You just cannot save that fast unless you're on an enormous amount of income. You just can't save $3,000 a week. This is why you need to be on the ladder. You need to be in the market. You need to be going upwards with it. If you're not, if you're procrastinating, and I talked about procrastinating in part 1 of this video series, if you're procrastinating, then you're going to be left behind. Even if you procrastinate for a year, that might have cost you $150,000. The house prices in Brisbane went up by $70,000 in the last calendar year. That's $1,200 per week. Okay, You know, that's a lot of money that you're missing. It's hard to save up $1,000 per week. So you need to be getting in and getting on the ladder as soon as you possibly can. And with property, it's time in the market is the most important thing. So look, to go back to our original thing, is property going to continue to grow? I would hazard a guess to say most definitely. It's still on the up at the moment. House price growth, as I said, I've quoted in a couple of the other slides that I've done that our house price growth is around 8 to 10% per annum. And people think that that might not be true, but we can have a look at the previous figures here and we can see that that is actually true. I mean, you go through the Brisbane figures, 11%, 9.7%, 13%. On average, over the longer period, it goes up by about 8 to 10% per annum. Okay, so guys, we've gone through the capital growth side of property, and it's fairly simple. Focus on capital growth. Where does the capital growth come from? It comes from the land, so focus on land content. Where are we going to put our property? Okay, we need to look at supply and demand, our basic economic equation. Now, once we've identified the state that we're going to invest in, we now look at a specific location criteria. And that's the best way to give us capital growth, or have the best chance of giving us capital growth. But now we're talking about building a property of 3, 4, 5 properties, 10 properties. So how are we going to do that? How are we going to keep everything afloat? This is where we need to focus on the second part of our property investing, and that is cash flow. So let's have a deeper look into that now. Cash flow is made up of 3 things. First of all, it is rent. Never buy a property that's not going to give you some type of rent income. Okay, people go out and they buy bush blocks and speculate on land and stuff like that. That's crazy. You do that, that's a surefire way to lose money, because if you're not, you're not getting any income from the property, so it's expensive to hold. And if you're not getting any income from the property, you're not allowed to claim any tax deductions, in the form of, the loan or anything like that. And if you can't claim tax deductions, then you're missing out around about 25% of the cash flow from property. So the next thing is tax deductions there, extremely important. And finally, we want to keep our maintenance as low as possible, okay? Now, people are probably thinking, oh, well, what about the interest rate? That has a fair bit to do with cash flow. Yes, it does, but our property selection doesn't have anything to do with the cash flow. Our property selection doesn't have anything to do with our interest rate. So whether I buy a townhouse or whether I buy a house is not going to affect my interest rate at all. So our property selection doesn't affect that, so I've left it out. Let's dive into each one of these in a bit more detail. Okay, I should also say, in order to maximize each one of those, we need to buy new. Maximizing our rents, maximizing our tax deductions, and minimizing our maintenance, we need to buy new. But I'm going to get into this in a little bit more detail. Okay, rent. 30% of Australians rent permanently. And out of that 30% of Australians that rent permanently, 90% of those people are in the lower to middle income bracket. What does that tell us? Okay, it tells us that if I've got $1 million or $1.2 million worth of borrowing capacity, do I go out there and buy a $1.2 million trophy house, trophy investment? No, I don't. I split that and I buy 2 median house price properties. Because if I buy $1 million plus property, especially if I'm looking, say, in the Brisbane area, then I've got a very limited amount of people that can afford to rent that property from me, and an even more limited amount that can buy that property from me if I choose to sell it or if I need to sell it. So therefore, if I'm buying something around the median house price, my target market is much, much greater. Okay, so don't buy the trophy, go for something that's affordable and also something that's new. Okay, get a new property because it's going to give you better rental return and it's easier to rent out. Tax deductions. Anybody know what the best tax deduction is you can get from a property? I'll give it to you. It is depreciation. Now, depreciation is the value of an asset diminishing over time, okay? Happens with all sorts of things. Happens with computers, cars, whatever you will, and it also happens with structure of houses as well. Land doesn't depreciate, but structures, so houses do. Let's have a close look at that now. So depreciation, okay, let's say our house here costs $250,000 to build. You can see this one's got a little solar panel on it, which is nice. that structure, so the house is made up of two separate parts. One part is the structure of the asset, okay? So that's the plumbing, walls, slab, roof, you know, all that sort of thing. And that makes up, in this particular case, $210,000. The second part is your fixtures and fittings, the internal stuff. Carpets, curtains, dishwasher, light shades, aircon, ovens, stuff like that. And we'll assume that that makes up the other portion of the 250. So 210 made up in the structure, $40,000 made up in the fixtures and fittings, aircon and all that sort of thing. Now the government allows us to write these two parts of the asset back to zero over a period of time. We actually get 40 years to write the structure of the house back to zero. So what we do is we divide 210 by 40, okay? And that gives us $5,250 per year for the next 40 years from the depreciation of the structure alone. Okay, so that's a fair bit. Secondly, if we write off the fixtures and fittings, we generally get about 5 years for those, but there's a couple of different depreciation methods we can use. But let's assume that it's over 5 years. So that means if we divide 40 by 5, that means we get $8,000 per year. So we're getting total depreciation of over $13,000 per annum. Now, if you're on an average tax rate of, say, 40%, so 1325, got my trusty calculator here, times 0.4, you're getting over $5,000, you're getting $5,300 a year back in actual cash. Okay, that's actually back in cash. So if your property's costing you at the moment, say $70 a week to hold, if you can then claim your tax deduction, your depreciation as a tax deduction on top of that, then that will turn your property from being $70 a week cash flow negative to being $30 a week cash flow positive. And this is what I'm talking about, getting a cash flow positive property investment. It's using all the tools that are there, the depreciation, the tax deductions, and other things that we can turbocharge our cash flow with, which we'll go on later, to make sure that our property portfolio is positive and it's not costing us anything to hold. Now, over a 5-year period, our depreciation just from our house alone, our structure, our fixtures and fittings, equates to almost $30,000. That's a lot. That's $30,000 in cash back over the next 5 years. That's amazing. It really is. So this is why you need to buy new so you can get the depreciation figures. And especially if you want to hold property for the longer term, you need to buy new. It's just going to be a far more pleasant way to own property. So we've gone through our depreciation in the form of our tax deductions in the form of depreciation. So what else do we want to be looking at? Okay, we don't want to be looking at any cash deposit. We want to borrow 100%, 110% actually. And why do I say that? And why do I put that under the tax deductions part? Well, because you've got to remember that we only get a tax deduction for the interest payments on the property. Okay, so we want to try and maximize that. If we've got any cash, spare cash, so rather than saving up for a deposit, if I've got spare cash, I don't put that against my tax deductible debts. I put that against my non-tax deductible debts, home, car loans, and things like that. The last thing that I pay down is my tax deductible debts in the form of a house. In the form of an investment property, I should say. I hear a lot of people saying, I can't save up for a deposit on an investment property. You don't want to save up for a deposit on an investment property. You want to use the equity out of the current property that you have, create a tax deductible debt through that, and fund the deposit. It's an easy way to go, and it's a far cleverer way to go. Okay, so no cash deposit, borrow 110%. And why I've added on the extra 10%? We borrow for our stamp duty. We borrow for our legal fees. We borrow for those things because some of them are tax deductible to us, but the interest repayments on them all definitely are. Any spare cash needs to be going into the non-deductible debts like your home. And this is why we do interest-only loans, because no point in paying principal back on a loan that's tax deductible. Let that one run if you've got non-tax deductible debts that are still out there. Okay, and do a tax variation form. A tax variation form is the unsung hero of property investing. People come up to me after my government workshops and say, Lucas, I'd love to own 5 investment properties, but, we've got one and I'm living on baked beans at the moment until my tax check comes back in 1st of July. And then I ask them, have you done a tax variation form? And of course they haven't. So once they realise that you can actually, rather than waiting to the end of the year to get your tax check back, you can get it in installments throughout the year. You can do it online, you can do it through your accountant. It's a very easy way to go, and it's going to improve your cash flow from your property out of sight. Our aim with our tax deductions is to get our tax payments, or our tax rate, I should say, at or below 10%. We're doing this for our clients at the moment, getting them down to around 5% in tax, which is amazing. You have to minimise your tax. Kerry Packer once said, if you're not minimising if you're Australian and you're not minimising your tax at the moment, then you need to get your head read. And I thought that was a great statement, because there's no doubt about it, that is true. Everybody should be minimising their tax. Okay. 5-year cash flows. This is a great slide. Now, 5-year cash flows at 7%, and the average interest rates, property generally takes around 5 to maybe 6 years to become cash flow positive. Okay, meaning that the rents need to pick up until they become cash flow positive. But now, if you're buying property in, say, southeast Queensland, where the yields on property are extremely good, you're getting 4.5 to, on some properties you can get 5 and 6% if you know what you're looking for. On rooming accommodation, we can get 8%, so that's quite interesting. But let's assume that you're getting, say, to 4.5%. Interest rates are at 4.5 or 4 to 5% at the moment, 4 to 4.5%. Your property is cash flow positive from day one, and that's without any of the extra, what I call turbocharging of cash flow. This is just a straight up 4-bedroom, 2-bathroom house with a double lockout garage. Should be cash flow positive from day one. So quite amazing, really. No longer do we have to wait for the next 5 years. So now is an amazing time to get started in property investment or to expand your portfolio. Not so much in Sydney and Melbourne, but definitely in the southeast Queensland area. Turbocharging our cash flow. How do we do that? Other ways of doing it. One way is we can do it through solar energy. Okay, we've been doing solar with clients and having absolutely amazing results. Now, it's not just any solar. You do have to be very, very careful with solar, and we'll get into that in a moment as to why you have to be careful with it. So you can do solar, you can do dual occupancy properties. Now, dual occupancy properties is like 2 houses under one roof, which we'll have a closer look at. And then putting dual occupancy properties on steroids is rooming accommodation. Let's have a look at these individually now. Solar income streams. Well, we can claim a government rebate. Now, that's the initial rebate that the government gives us for putting in the solar system. It's not the feed-in tariffs, but it's initial rebate, and it's equivalent to a few $1,000s there. Okay. Next one is if we own the solar system, we can charge the tenants for that. Okay. So sale of solar power to tenants. So a great way to make money through your tenants is to sell the solar energy to them. And we sell it at a slightly discounted rate to the grid power, so they're very, very interested in doing that. Okay. The solar feed-in credits, so whatever the tenants aren't using gets fed back into the grid power, and then we get paid for that as well. Okay, so it's quite an amazing investment, solar. And we also get the depreciation on the system as well. Now, this solar, as I said, and I'm going to get to it in a moment, it's not just any solar. You need to have a specialised solar system, and you need to talk to us further about that, because it is a little bit tricky. You need a third-party billing arrangement to do it. Don't just race out there, put a solar system on your roof and expect that this is going to happen, because if you put a solar system on your roof for the tenants, and the tenants have the solar bill in their name, then they're entitled to the feed-in credits. They don't then have to pay you for the solar power, and you are just going to have wasted your $8,000 of putting that solar system on the roof. So it's not something I'd be doing. You need to talk to us first. So as I said, it's not just any solar power, it's a specialised one. You need a specialised third billing arrangement or you cannot bill the tenants. So be very, very cautious of that. Just don't jump online, find the cheapest one available and pop that on your investment property because it will not work for you. It's been tried in the past and it will not work. It took a lot of work for us to come up with the correct solar billing arrangement and the solar setup to enable us to actually claim the feed-in credits and also to charge the tenants for the solar usage. Okay, dual occupancy properties. Now they've been very popular over the last few years, and what it is, and this is a classic setup of a dual occupancy property, and we've built these many times over. It is 3 bedrooms on one side with 2 bathrooms, and then on the other side we have 2 bedrooms and 1 bathroom there. What that does is it looks like a 4-bedroom home from the front, but it's what we call a dual occupancy property with 2 families living under the one roof, separated by a firewall. And what that does is that really increases our cash flow. They're more expensive to build than your standard 4-bedroom home because you've got two kitchens, you've got 3 bathrooms, etc. Firewall is very expensive to build, but they do increase your cash flow significantly. So something to worth looking at. You just have to be careful about where you put that because there's only certain areas that will allow you to build dual occupancy properties. And I know people have been caught in areas building the wrong thing in the past. Rooming accommodation. Now, rooming accommodation is taking the whole dual occupancy thing to the very next level, and it's turbocharging the turbochargers, like a twin turbo if you want to call it that. It does amazing things for your cash flow. So rather than renting out 1 property or even 2 like the dual occupancies, what we can do is we can build a 5-bedroom house. Each of those bedrooms has its own kitchenette and its own bathroom in there. And what that allows us to do is to rent out each room individually. So rather than getting, say, $450 per week for the whole house, what we can do is we can get $250 per room. So you can just tick it over in your head and work out the difference in cash flow. It's amazing. We're talking 8-10% yield off that particular investment. So it's a great way to turbocharge your cash flows. Amazing thing. Okay, so we rent rooms individually. The council regulations are quite tricky with this, so don't just go out and start building 5-bedroom houses with kitchenettes because it's quite tricky, and the financing of them can be tricky as well. And it's only in certain areas, and you need to know where those areas are because if you mess it up, then you're in big trouble with the local council. They'll charge you contributions fees, $30,000 per room. Oh, it's just an absolute nightmare. So don't go down that track unless you know exactly what you're doing, or come and talk to us. Okay, I want to give you an example of one of my clients and how he restructured his portfolio. It's a very good one, actually. Justin's a great guy. Just a medium income earner, not a high income earner by any stretch of the imagination. Had 1 investment property that was not performing for him. It was killing him in regards to cash flow. He just set it up in the wrong financial structure. He found that he couldn't, he was dying, great guy, wanted to expand his portfolio, couldn't do it because the property was just costing too much and he was just affecting his lifestyle. The financial structures at the end of the day were set up incorrectly and he got poor advice around that. And his loans were set up incorrectly as well. He's paying a high rate and the money wasn't flowing through the correct accounts in the right order. And he was just, to be honest with you, busy at work, just too busy to fix it all up anyway. So his goal was, he came and saw me, we sat down, his goal was to retire at 60, guy's 40, retire at 60 with $65,000 of passive income from his property portfolio. Let's have a look and see how he's going. Okay, and maintain his current lifestyle, and I should also add this. And one real great thing is Justin, a single guy, wanted to go and live for 6 months of the year in Europe. Okay, so I suppose if you're a single bloke, you can do that, which is great. And if you have a passive income coming in from your investments of $65,000 a year, you can do those sorts of things. People talk about, I want to go and live overseas for 6 months of the year and all that. But unless you've got passive income coming in, how are you going to go and live in France if you can't speak the language? Where's the money going to come from? You need to have passive income in Australia to be able to do that. So Justin, his goal is to retire at 60 and then just travel, live overseas for 6 months per year. Great, good on him. Okay, so he's 40 years old. His home was worth $460,000, so not extravagant by any stretch of the imagination, and he owes $125,000 on that. His salary is $70,000. So he's like what I would call a medium income earner. Probably not medium if you're living in Sydney, I suppose. Superannuation, $85,000. He's not been putting anything extra into that, so he's just been getting 9.5%. He's got one property. Its value is $450,000. Its debt on that is $400,000, and his rent is $24,000 per year. His current outcome, if he did nothing in the next 20 years, how would it look? Well, his superannuation and his properties, the yield on those, and I won't go through all the figures because, this webinar will drag on all day if I do, but the yield is going to be around about $51,000 per year in the next 20 years. So remember, that's dollars in 20 years' time. So when we're talking about today's dollars, remember we've got to imply inflation and money halving buying power around about every 15 years. Justin had 20 years, so he's got to bring it back by a little bit more. So he's looking at retiring on around about $17,000 per annum. Okay, and remember his goal was $60,000 per year. So what did we do? Okay, as we said, we set some goals. That's the first place to start. Retire at 60. He's 40 now. Retire at 60 on $65,000 per year. Maintain his current lifestyle, so he doesn't want to affect that because the guy is single, and he wants to live in Europe for 6 months per year. Great, fantastic goals to set, and Justin will make those. So what action did we take to make those goals happen? Well, we restructured his portfolio and expanded it as well. So restructured how he was holding those assets, or that asset, I should say. We restructured his tax, and we put in some implementations to turbocharge his cash flows, okay, from his property investing, so they weren't costing him anything. And what that enabled him to do is to also pay off his own home a hell of a lot faster, which he really needed to do. Okay, the outcome of what we did, we managed to expand his portfolio by one property. We reduced his tax rate, we increased his cash flow, and now Justin is able to pay off his own home faster. So pretty soon he's going to be rid of his non-tax deductible debt. That will give him more disposable cash, and he's going to be able to expand his portfolio again. And he needs to do that another 2 or 3 times by the time he's age 60 to be able to retire on the goals that he would like. So he's an outstanding client, really focused and really doing it, and we can certainly do that for you as well. Okay, so and as a kick off there, we've got our client is now investing correctly, which he has done. So guys, that wraps up what we call our compound growth structure, how to make the most out of your property portfolio, and importantly, how to not only get cash flow positive property, okay, cash flow positive property, which is close to the CBDs, but also with good capital growth as well. People think it's an anomaly. It's not. It can be done. My clients are doing it at the moment. I'm doing it myself personally, and you can do it as well. So don't listen to the people that say that property costs you a lot of money to hold, because it doesn't. So the end result is this. The end result is the red bar is your debt and the green bar is the value of your properties. And the difference between the red and the green, that's your capital profit, your wealth, I suppose, the difference between what you owe and what your property's worth, and that continues to increase year on year, okay, at about 8% per annum. Just got to keep our debt levels around about the same. So that's why, to be honest with you guys, that's why wealthy people continue to get more wealthy, because they hold a significant amount of assets, okay, and those assets over time just increase in value. The Rogers Property Group, quick rundown on what we do for our clients. Well, we provide independent advice to our clients around property strategy and investment. We set everything up right from the start, so there's no need to go back there and have to redo stuff. We make sure that you have the right financial structure to deal in to start off with, okay? Whether that be a self-managed super fund, trust, own name company, whatever that may be, depending on your property strategy. We research locations and statistics for our clients to make sure that they're getting not only the very best cash flow, but also great capital growth, so they get the best of both worlds there. We make sure we do cash flow analysis for all our clients before they get started, because there's no point in diving into some type of investment and it's going to affect your lifestyle and you know, it's costing you $200 a week to hold. That's silly, because you're going to be a slave to your investments, you're going to hate it, and you're not going to continue on in the longer term. And we help you organise your team. Well, you need a good property manager, you're going to need a solicitor, you're going to need an accountant and so on. Now we can help you organise those people. But I always say to my clients, it's very important that you know that you can use anybody that you like when you're dealing with us. We don't corral our clients into a corner and make them use who we're recommending. They can use whoever they like. Gives them a sense of independence as well. So that's a quick wrap up of the Rogers Property Group. Now, if you want to get in contact with us, you can get in contact with me personally at info@rogerspropertygroup.com.au or 1300 148 178. And please go to our Facebook webpage and Instagram and follow us on that, subscribe to that, and you'll be updated with all the latest content. So guys, I really want to thank you for listening to me. Please send me an email, request a copy of the book. Any questions or anything that you have, please let me know. And look, if you've enjoyed these 3-part series to this webinar of cash flow and capital growth, then please do me a favor or do your friends a favor and share it with them. You'll make a huge difference to somebody's life. And remember back to our first part 1, where I talked about getting the mindset right to be successful in property investment. Set goals, act upon those goals, and don't procrastinate. Really, really important. Just get out there and do something. So set goals, act upon your goals, and be persistent and consistent with entering those goals. Guys, I really hope that I catch up with you in the future, and I really want to thank you for listening to me. Thanks very much.